Here again. Today is March 11, 2025. I'm Paul Meeks, your host of Tech Tune-Up, and I do this in conjunction with Harvest Portfolio Management, where I work and run my tech models here in Charleston, South Carolina, and of course, as always, my buddies at Benzinga, specifically on their YouTube channel. As we get to the end of this program, please fire away any questions. So start to think about them. As I promised 3 subscribers last time we met here, I have looked at your stocks and I will comment on them in just a bit. So what we try to accomplish in this half hour or so is a deep dive into some tech stories, and sometimes the stories around the stories. And sometimes the stories are specific to the name, and sometimes they have broader implications. Then we go into my list, which I've refined more recently, and then we'll talk a little bit about tech trends before we get to your questions. So let's go through the tells. Next week, beginning on Monday, Nvidia is going to host their big to-do conference. I imagine that CEO Jensen Huang speaks on Tuesday. And if this is not a catalyst for Nvidia's stock, I don't know what is. Though I was a little bit negatively surprised that despite the fact that the company's quarter was clean and the guidance even a couple of weeks ago was fairly bullish, that the stock still cratered. So I will tell you, we're obviously in a risk-off situation with the marquee name of the last couple of years, Nvidia, getting hit just for being the standard bearer and perhaps getting a little bit expensive. Taiwan Semi, I've reported this before. This is very good for Taiwan Semi and very bad for Intel. That Taiwan Semi is now essentially telling the feds in the US they're going to spend up to $165 billion over the next couple of years on fabs, 2 underway in Phoenix, Arizona. They are not going to probably do anything at all with Intel, and that could be the death knell for that company. Another real problem for Intel this week is when Trump said at his State of the Union address that he wants to pull the plug on the Biden-era CHIPS Act, which was heavily laden with government support for Intel's venture into manufacturing others' chips. If that goes away, really bad for them. As I've said before, at the end of the day, yes, we will make semiconductors in the United States, but it looks like they'll be primarily made by the Taiwanese and the South Koreans. So that's okay. Marvell was a stock that I had supported as a non-NVIDIA AI play because Marvell and Broadcom, ticker symbol AVGO, had been supporting the custom ASICs being developed for AI applications by the hyperscalers, whereas most everybody else, including the very same hyperscalers, typically use the chips from Nvidia. But Marvell had a kind of a squishy quarter. I told you I would report back on it. And I think that with their guidance, which was really disappointing in my view, I think that they are losing some market share in this AI ASIC space to Broadcom. And Broadcom followed up the very next day with their quarter, and their AI specific guide was for a nice revenue acceleration on a sequential basis this quarter to next. So when I take a look at those 2 plays, which I previewed last week, now we've had their calls, I'm in favor of Broadcom and I'm not in favor of Marvell. So we'll see what happens. Broadcom has done quite well, even though the market has been blitzed in the last few days. Maybe X today, get a little bit of a bounce. I'm still waiting on AppLovin. Fundamentally, I'm there, but we've had this chatter, which, by the way, the chatter from the short sellers is kind of interesting because they made accusations that should really rattle the cages of the app stores that AppLovin is on, specifically those at Meta and Alphabet and even Apple. However, unless some stuff has happened behind the scenes, they chose to not follow up. Also, of course, you would have expected if there was accounting fraud that the SEC would announce that they're launching an investigation. No such thing yet. And of course, the two short sellers have pushed the stock exchange pretty hard to delist AppLovin. Again, as of yet, no follow through by any of these people. And so I'm feeling better about the fundamentals at AppLovin, getting a little bit of a bounce today. However, I still wouldn't add to it. I am waiting to pounce, and I will pounce aggressively, but I need to see the stock bottom out, or I need to see a little bit more confirmation from the company and some of its supporters that everything is on the up and up there. I would think that they'd be a little bit more aggressive about voicing their support. So we'll see what happens. But anyway, that's my go forward plan with AppLovin. Apple's kind of interesting. You know, my problem with Apple is, it hasn't grown for a couple of years. And now they've announced that they're delaying AI on Siri. I never was going to upgrade my iPhone 14 for AI on Siri anyway. But anyway, the bulls that have loved this stock have been pining their hopes on an acceleration in total revenue driven by a really big acceleration in iPhone revenues, which is 60% of the whole enchilada at Apple, driven by everybody, regardless of how fresh their current phone is, going out and upgrading to embrace these AI functions. Well, we'll see what happens. Unfortunately, the story is not getting better. It's getting worse here with the delay. And the stock, for the first time in a long time, has fallen below its 200-day moving average, which technically, as you know, is probably an ominous sign. Hewlett-Packard announced their results. I had been in favor years ago of Supermicro and Dell and Hewlett-Packard Enterprise for all the wonderful traction they were getting in selling AI souped-up servers for data centers. Dell, I pulled the plug on a while ago. SMCI, I pulled the plug on a year ago. And even Hewlett-Packard this past week had a quarter, which I thought sucked. And things are going so poorly, they've already been firing people, and now they're going to increase the number of people that are going to be let go by another 1,000 or 2,000. So that's real bad. So I'm off this particular case, this industry within the tech sector. CoreWeave is a private company that is going public shortly. I've been talking about it for a while. They got a very nice deal with OpenAI, including some equity ownership, investing in a private offering ahead of their IPO, which will potentially be the biggest tech IPO of the year. And that should be coming down the pike within weeks, probably 1 to 2 months on the outside. So continue like CoreWeave. And hey, you know what? I've been a holder of this private company for a while, so I'm pleased about that. Oracle last night, kind of a squishy quarter. I'm actually surprised that the stock is not down more than it is. Their guidance was weak, and I'm starting to doubt, their role as a major player in cloud and AI. In the past, I've been really rooting for Oracle Cloud Infrastructure, OCI. But we'll see what happens. Maybe they come back and turn it around and reaccelerate revenues. But right now, you got to stay away from that particular stock. I like the announcement from Uber. Now, this is not a surprise, but at least now it's formal, that Uber and Waymo, which is part of Google and Alphabet, are going to go live with their autonomous rides in Austin, Texas. And of course, that's right in Tesla's backyard. So this is going to be beneficial for both companies. I've always felt that at the end of the day, Waymo might be the better autonomous driving bet than Tesla. and that Uber and Lyft would not be disintermediated by autonomous driving, that they actually will be needed as essentially a dispatch for riders. And so they will play in this theme, and they'll play nicely because it might even be a higher margin business for them than their current business. So I told a couple of subscribers that I would follow up on a few companies, which I knew, but not really enough to comment on. But here's what I think about. We have Impinj, right? So Impinj is a company headquartered in Seattle that I actually used to visit quite a bit because I worked in Seattle as a CIO of a money manager between essentially 2012 and 2018. So I knew the company pretty well. But I will tell you, after looking at it, I'm staying away. I mean, the problem is this year, their earnings per share is supposed to be cut in about a half from last year. And so you really need to see a reacceleration of growth and a big one in the out year. And as of now, with this huge miss from original forecasts, I'm going to kind of put this in the penalty box. And even though the stock is way down, and so it's tempting if you like something to buy it when it's down. I don't know. I think there are bigger fish to fry, and I'd actually stay away from PI. The next one is Credo. I support the fundamentals here because it is at least a derivative AI play, and we know that infrastructure demand, despite what everybody's saying, is still pretty strong. But even though it has a decent chart relative to most companies, I think you got to watch the 200-day moving average, and you got to support the 200-day moving average before you even add to it to average down your purchase price and even to initiate a new position. So the next one is Axon. I guess out of these three, this has the really only salvageable, since Credo has broken through its 200-day and Axon is still above it. But even though I do agree it's a worthy AI connectivity play, and it appears a pretty good business model, I'm waiting for the stock to show me a test, and I imagine that it happens, of its 200-day moving average, which is $457 per share. And then if we hold there, I would get more comfortable. We're just in a risk-off situation now. So even my fundamental stories, and I think this one's a pretty good one, I need to see two things happen. Fundamentals, check. Technicals, check. And right now it's hard to find one tech stock that has at least a semblance of a decent technical profile. The last thing I will tell you that I've been doing is I had bought, as a play to diversify my AI tech-heavy book, I had bought some Boeing because I was pretty bullish on their CEO and the transition plan, the improvement plan, and I still am. But here's the problem. I sold half my position today at a loss because we're just not going to be able to escape with Boeing, which is one of America's largest exports and one of America's few notable exports, the Trump tariffs and the uncertainty here again, off again, Trump tariffs. So anyway, I cut my position in half and used those proceeds to start just a starter position, Robinhood. Talked about Robinhood last time. Even though it'll trade quite often with crypto, and crypto is obviously in risk-off mode, I think Robinhood has some good stuff going for it. It's a way to play crypto without buying the coin. They're spreading their tentacles into Asia for the first time, and it looks like they are taking equity trading share and, of course, some crypto trading share. So out goes half of my position of Boeing, proceeds to buy a half position or a starter position in Robinhood. Stay here for more alerts. So let's get to my stock list. I'm trying to refine things today, right? Not to have everything so cluttered. So what I'm doing here, and I'll change these from time to time, of course, given information flow and valuation. Let's just focus on the stocks that I would like today. And I am buying, whether they're tech or non-tech stocks, as a way to be defensive in clearly a risk off, tech off market. I mentioned earlier Broadcom, I like very much. I like the fact that they could be taking share from Marvell and have guided very concretely to AI revenue acceleration sequentially this quarter to next. Guidewire, we've been right on that name. I've held it for a while. Citigroup, yeah, it has been a diversifier for me, was working out great. Now, not so much, but it's still holding its 200-day moving average. And I still think Citigroup is the cheapest of the mega banks, and I'll still buy it here. T-Mobile is another chicken shit way to play tech. I've been there. Take-Two Interactive, it is a idiosyncratic story with the launch later this year, specifically this fall, of Grand Theft Auto 6. And so I continue to like it. The old Raytheon, now called today RTX, is there. I am trying to hedge my risk a little bit with the gold ETF. Alibaba, I like what they're doing, and I like their valuation that they're coming to the dance with over there in China, and the fact that they are now in cahoots with Apple to help Apple bring AI on its devices to the Chinese market. I've been hiding in some Duke, the electric utility, and I've been hiding in an industrial called Linde, the German-backed gas company, natural gas company. And so, yeah, I like all of these names. Again, I encourage you to not necessarily chase tech stocks to the bottom with the view that you can always buy them lower. I say that, a good thing to do is when it's not working and the technicals absolutely suck and there's fundamental uncertainty, as there is with Trump 2.0 so far, it's not a bad thing to just wait in cash or buy some defensive names. You don't always have to be manic with the depressive and buy stocks as they go down. I try to, in times of panic like this, circle up, concentrate my best ideas, sell the dead wood, and really prepare myself for the rebound with the right portfolio. So now, not a bad idea, like I'm doing with Boeing out and Robinhood in, to shuffle deck a little bit. But all my positions are carefully bought, sparingly bought right now, because until further notice, we are in a risk-off mode. So with that, let's get into some of the most popular tech trends. This is very interesting to me. We were all worried as recently as a week or two ago that the Fed might turn around and raise rates because they were worried about inflation. Well, now all the talk is about are some of these uncertainties surrounding Trump's policies going to actually drive us to a recession? And so the next move with the Fed could be to lower rates to help resuscitate the economy. It is very, very interesting. I will still tell you that I think overall, not in every case, but overall, tariffs are inflationary. So I still worry about that. But I think that the Fed, when they next meet, which is going to be pretty soon, in 8 days, March 19th, that they will do nothing again with their benchmark interest rate. However, when they next meet after that, which is May 7, I believe, given the latest concerns about a softening economy in the U.S., rather than increasing inflation and interest rates, that the Fed will lower by 25 bips come the beginning of May. And if we get into a streak of lower rates, despite the continued anxiety about geopolitics, I think that'll put a floor under the market. So you know that the Fed will rush in for a rescue. And so that's the bad thing is economy weakening. The good thing is we maybe take these interest rate hikes off the table and replace them with reductions, which are typically a huge valuation boost for tech and other aggressive growth stocks. So the Chinese have a powwow once in a while, and they not only reveal their plan for the next year, but their economic plan for the longer term. And this is interesting to me, despite all the cross currents, is that they have a pretty aggressive target for their GDP growth in 2025. So it's going to be game on in this battle with the United States because the Chinese seem to, with their guidance, continue to be aggressive and seem to maybe take advantage of what's going on here. I would have thought that the Chinese Communist Party would have been a little bit more calm, cool, and collected, and maybe keep the bar low so it'd be easier to step over. But nope, they're stepping on the gas, going the other directions. And then obviously what they do does at least indirectly impact us. So stay tuned. I just thought it was interesting economic data point coming out of China. So we know that these on again, off again tariffs are destabilizing. And of course, over the weekend, which led to a big market meltdown on Monday, Trump said on Sunday morning talk show that he and Treasury Secretary Scott Bessent seemed to agree that for long-term gain, that will take in the United States some short-term pain. And that short-term pain includes potentially triggering a recession, although it'd probably be pretty short. So I will tell you, I'm a fiscal conservative. So I actually like some of the things he's doing, but the tariffs I don't support, and the uncertainty makes it very difficult to invest. So again, if I had my druthers, I would buy a short-term treasury, right? You can earn about 4% annualized on those securities, totally risk-free. And you don't always have to play the game, man. You don't always have to play the game. We'll see what happens here. And then, of course, we've seen at least maybe a little bit of a rebound today, but we've seen unwinding of the momentum trade. That continues because when you have an unwinding of the momentum trade, you just see some of these tech stocks, particularly something like Nvidia, that confirmed fundamentals, very bullish, and yet the stock went down. So what can you do with those? If you're fundamentally right, it doesn't matter. The only thing you can do is if you want to play momentum, right, you have to wait until these stocks settle. And if you don't want to play momentum at all, and that still is probably a pretty good choice, invest in some other stuff until we can welcome the momentum stocks again. So with that in mind, let me know if you have any questions for me today. Here comes a question. I'll read it verbatim. Are we in market pullback or crash? What are your thoughts? Thanks for your time and wonderful insights. Well, of course, I like the last bit. Are we in a market pullback or a crash? I think we're in a market pullback because I think that the Fed will come in as they do with the Fed put, and if the economy looks to be too weak, they will lower rates at that May 7th meeting. They may not get to it in 8 days at this meeting. So if rates go down, that'll support things. Also, if we get some clarity on the tariffs, and Trump and his Commerce Secretary and his U.S. Treasury Secretary can all convince us with their appearances on television and in other media that, yes, we're suffering short-term pain, but it's going to be for a really important long-term gain. If they can articulate that, yeah, I think that we will have a continued downdraft, right? The NASDAQ has already gone into correction mode, down 10%. but I don't think it's going to be anything long lasting. But excellent question. ASTS has had an incredible run on direct sell to satellite. It still have legs to go further. It comes from my buddy Greg. Don't know enough about it, Greg, but you know what I will? I'm going to bone up on it and check in next week, and I'll give you my answer. Can you look at Tesla? Well, I'm worried about Tesla. You know, I've always been a bear on the name. If you've been following me, I guess that's been a good call as of late. So here's what I think about Tesla. So Tesla was trading about where it is today before we got wind that Trump was going to probably win the election, which of course Tesla and Elon Musk specifically were seen as beneficiaries, and they were, of the initial Trump bump. But now that the bloom has come off the rose, the stock has retreated all the way back down to essentially where it was trading in mid-October before it started to roll. So we're only back to where it was before the Trump bump. However, between then, which the Trump bump was really started in about the middle of October, the election was November 5, the company, Tesla that is, has announced one quarter that was, pretty bad, right? First time they had a decrease in deliveries. And then we've had some incremental data since their report. Poor sales in China, no surprise. Poor sales in Europe, a bit more of a surprise. So the fundamentals of their EV business really suck. And you really have to believe that they're going to be wildly successful in humanoid robots and autonomous vehicles. They may or may not be, but in the meantime, their core business is really weak. And the most recent data shows it's only getting worse. And we've had essentially the unraveling of the Trump push. So I would not buy the stock, even though it's come way, way down, because it's only back to the price before Trump got elected. So I would say that it doesn't really incorporate yet the fundamentals that have materially worsened since that time at the middle of October. So I don't know if you can short Tesla, but I don't support buying it here. What's your take on STX and DocuSign regarding AI? STX should be a beneficiary, but I've been wrong on some of these indirect plays. I think if you want to find AA derivative stocks, I don't know if I would lead with either one of those companies, but you could say that both DocuSign and STX on the storage side should be beneficiaries. But what I do, as I've said, I'm reshuffling the deck, concentrating my portfolio, and getting prepared for the rebound. I don't think I would have those two stocks on the list. I think there's too many better, more obvious opportunities. All right, guys. Well, I appreciate your comments. I'm going to follow up on that stock that I mentioned, just like I followed up today for the three stocks that I was encouraged to look at last week. So come on back, man. We have some crazy comings and goings in technology. But remember, you won't hear it from anybody else. When you listen to most talking heads on television, and I'm on all those networks too, they're going to try to encourage you or make you anxious. So you have to buy, sell, buy, sell, buy, sell. Sometimes the right answer is to do nothing. So at least think about that. And I'll see you next week.